Alright, folks, welcome back to the channel. Today, we're diving right into the chaos brewing at American ports, and trust me, this one's big, like, affects half the economy, big. We're talking about dockworkers' contract disputes, automation, wage wars, and the broader implications for the US economy. Yeah, buckle up, this is not going to be a smooth ride. From the East Coast to the Gulf, various ports representing half of all US container volumes are staring down a potential shut-off valve thanks to looming strikes. Doesn't sound too bad. Oh, but it is. Let me explain. The International Longshoremen's Association, ILA, and the U.S. Maritime Alliance, USMX, which represents shipping companies and terminal operators, are butting heads again, big surprise, on automation. They have just resumed talks to avoid a collapse when the temporary extension on the labor contract ends this month. But, as usual, the issue isn't just money. Sure, there was that tentative 62% wage bump deal a while back, but the real powder keg is whether semi-automated machinery can be used in port terminals. Union leaders say these machines are basically job-stealing metal monsters, while employers and shipping companies argue that without tech boosts, U.S. ports will fall behind foreign competitors, dragging the broader American economy with them. Now, if there's no deal by the January 15th deadline, ports across the East Coast and Gulf Coast could shut down, which would send shockwaves throughout industries from manufacturing to retail. And guess what? That means you, the consumer, would feel this bite as supply chains slow, empty shelves rise, and prices would shoot through the proverbial roof. Let's break it down. What does this mean for the economy, and how did we get into this mess in the first place? Here's the thing, this problem isn't new. The battle between man and machine has been raging since the Industrial Revolution, but it seems to be back with a vengeance. We're seeing a major fault line opening up between automation designed to boost productivity and humans wanting to maintain job security. Both sides, of course, make compelling arguments, and both are crucial to understanding the broader economic woes plaguing today's labor markets. Automation is supposed to make ports more efficient, reduce operational costs, and keep the U.S. competitive on the global economic stage. With container volumes skyrocketing post-pandemic, U.S. ports handled more than 52 million 20-foot equivalent units, TEUs, in 2022, a 6.6% increase over 2021's totals. The pressure to modernize infrastructure has never been higher. Global freight shipping has gone through the roof, and every minute of port downtime costs big bucks. According to some estimates, West Coast port shutdowns in 2015 cost the U.S. economy $2 billion per day, per day. These are large dollar figures, folks. On the flip side, union members feel like automation is the final nail in the coffin for decent-paying vocational jobs in America. Once you bring in those high-tech cranes and semi-automated loaders, who needs humans, right? The longshoremen argue that they'll get pushed out for robots that don't sleep, don't get sick, and don't have kids to raise. That's a real, tangible fear, and your job security is under threat in an economy that's already fragile for blue-collar workers. Dock workers have high stakes here because of how centralized port jobs have become under increasing monopolization in U.S. logistics. This is a broader labor market trend affecting other industries, like autonomous driving threatening truck drivers. Now, hello, the elephant in the room here is clear: the lack of proper U.S. policy managing tech disruption in these labor markets. Sure, some would argue free market competition means industries should transition fast, tech included. But what about devastated communities left behind by the march of the machines? Sounds like classic mismanagement, another example of government indifference combined with private profit-seeking. This brings us to a critical question about automation's economic impact. On one level, more machinery at the ports could make America more competitive. With economic rivals like China and Europe investing billions into modernizing their port systems, American ports must keep up. We're not simply talking about logistics here. Modern, efficient ports form the backbone of a well-functioning supply chain. With retailers relying on just-in-time deliveries, disruptions at ports could spell disaster for businesses across the country. Data to chew on: automated ports are reportedly 30% more efficient and lead to 50% fewer equipment breakdowns. Long Beach, California's automated terminal managed to unload an 18,000 TEU megaship in just over 3 days, record timing that reduces port congestion and makes companies within a supply chain more productive. Deloitte forecasts that port automation would lead to cost savings of over $460 million annually just at the top 10 U.S. ports. However, what automation enthusiasts don't tell you is that for every efficiency gain, there is a human being with a family, home, and bills to pay who might be out of a job. That might sound a little old-fashioned, but when looking at broader unemployment in the logistics sector, its impact is undeniable. Tens of thousands of stevedores, truck drivers, and warehouse workers could be phased out in favor of machines. That leaves unions no choice but to dig in their heels. For the ILA, it's about survival. Introducing more machines at the ports doesn't just mean fewer jobs for tomorrow, it means whole livelihoods could be erased. President Harold Daggett himself stated a year ago before Congress that, "I won't sign an agreement that puts my members' jobs on the chopping block." Folks, what we're seeing now with this port showdown is a microcosm of a larger issue, the impending clash of labor rights with the unstoppable rise of automation. And of course, the buck is going to stop with the federal government. But is Washington, D.C. taking this seriously? Oh man, if you thought things were messy at the docks, wait until you look at D.C., where the policy apparatus seems to be stuck in neutral. Traditionally, elected officials have folded their arms, screaming, "Let the free market sort it out." But can we really afford this laissez-faire attitude any longer? Let's face it, as automation is creeping into more industries, from McDonald's burger-flipping robots to driverless Uber taxis, what's the government been doing to help transition workers? Practically nothing. Right now, there's no serious national program in place to help mid- or low-skill workers retrain or upskill for the jobs of tomorrow. Zip, nada. No social safety net expansions or even meaningful education reforms. Some 70% of Americans believe that government isn't doing enough to limit job loss from automation, according to a recent Gallup poll. And folks, this isn't an opinion. It's a fact that U.S. public policy hasn't caught up with economic reality. While other countries, like Germany and Denmark, have launched state-backed retraining programs that include workers laid off by digitization, here in America, we've just been kicking the can down the road, hoping the whole tech displacement conversation will go away. Now, here's where things get interesting, it's the return of Trump. Yes, folks, the soon-to-be inaugurated Donald Trump has jumped into the fray. He's publicly opposed to automation on the docks, siding with the dockworkers. Given his blue-collar voter base, this doesn't come as a surprise. Trump rode into the White House last time telling offshore manufacturing to get back onshore. This time, he's promising dockworkers that he'll protect their jobs from automation. Whether you love or hate Donald Trump, one thing's for sure, his stance could complicate negotiations even further. If the government begins threatening regulations on port automation, that's going to spook shipping consortiums and global trading partners alike. Tariff talks aren't helping the situation either. Maersk's comments from earlier this week warned that if the threat of automation stalls a deal, we could be in for another round of disruptive trade wars. Rumors are already flying about tariff hikes under Trump's new round of economic policies come 2025. Drewry Shipping Consultants, a prominent supply chain forecaster, has already raised panic levels, predicting sharp hikes in trans-Pacific trade lanes if port strikes hit. Spot container prices have jumped more than 9% since early December 2024 just in anticipation that a major disruption is unavoidable. And that's just preliminary. If ports really go offline on January 15, brace yourselves for a cascade of inflationary pressure as slowed imports mean tightened inventories, retailers and manufacturers marking up costs again, package delays for the average consumer, and fresh rounds of inflation undermining household budgets. Talk about a shot across the bow. While the media focuses on how this mess at the docks affects supply chains, let me bring this back to how you will feel it directly in your pocket. Disruptions mean rising consumer costs all over the map. Already last year, basic goods jumped higher because of lingering supply chain issues from COVID and Ukraine war-related shortages. We've seen barometers like the Consumer Price Index, CPI, balloon more than expected since mid-2024, approaching an 8% year-on-year increase just last month, outpacing wage growth yet again. Empty shelves will mean higher inflation follows like a shadow, something that most Americans simply cannot survive amid rising interest rates, stagnant wages, and growing consumer debt. Credit card balances skyrocketed to over $1 trillion this past year. In the retail space, stores like Walmart and Amazon face significant logistics costs and stock shortages, directly impacting sales margins. Analysts expect more corporate pricing gimmicks coming soon from switching suppliers, read, lower quality goods, or even deceptive shrinkflation tactics. You will not like the results. That coffee you buy, your kids' back-to-school supplies, everything, gets pricier. And it's mainly because policymakers are incapable or unwilling to solve fundamental labor and trade disputes while maintaining volatile supply-demand challenges. So here we have it, folks. From a possible port shutdown disaster to misguided attempts at automation fixes, all signs point to the U.S. economic recovery plan sitting on a house of cards. The incoming strike setup tells us much more than just about logistics divisions. It's a symptom of far deeper fault lines in policy, automation conflicts, social inequality, and unaddressed structural problems hindering any real sustainable economic growth. Mark your calendars for January 15, but maybe don't expect fixes until our government decides it's time to leave committees and act.